Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for May 25th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything we talk about here today is just my own opinion and not a direct trade recommendation. But if you are interested in getting active in trading futures or commodities, and certainly talking to somebody like me is a great way to get going. My number, 312-277-0110. You can find my information and contact information at the end of this video and in the comment and information section of this video. So with all of that being said, going a whole lot of nowhere and a whole lot of markets. Soybeans, a little bit of a capitulating move down to test 13 bucks again, but we scramble back inside the trading range we've otherwise been trapped in. And if you, over the last 5 days of price action, if you look at where the average of price has been, for example, just a real quick look here, 1325, 1326, that's kind of just reversion to the mean. If you kind of take out Monday's 1345 high, and well, I guess you don't even need to take out that high, and so long as you include that 1305 low, right, 22 and a half is right between, well, I guess 1327, I should say, and a half is right between those levels in the middle. So not much you can take away from the last week of price action for soybeans. And stepping out a little bit further, I guess we'll begin with beans today. Stepping out a little bit further, and interestingly enough, starting with the 15-minute chart, moving out to the 4-hour, kind of complete reverse of how we usually look at the charts. But then stepping out a little bit further, you can see the clear trading range, right, that we've been in, below 1340. The market might be in consolidation with another push towards 1285. It'd be the next in the series, having taken 2 steps down, 1 step up into resistance was into that 1345 area. There's certainly a trend line from the start of May through highs for that first 2 weeks that comes in around 1350 here. So good reason to believe and technical reason to think that, okay, consolidation below those levels makes some sense right now. The larger level, as you step back out on that 4-hour chart, you come to the realization that since September of last year, July beans are holding above 1380 to 1400, and breaking below that threshold was a break of a consolidative range low, and a move back up to test it as resistance wouldn't be out of the question. So in a true short covering rally in the near term, I think getting back towards 1382 is not technically out of the picture, nor would it be would it really be that different than some of the other bounces the market's seen since it made its 1546 high there in January. Of course, we were a little higher than that before, but the most recent high that has started this otherwise downtrend for that has been unfortunately been the story of 2013 for soybeans, or excuse me, 2023 for soybeans, which ironically, Freudian slip, but the charts of 2013 for row crops, particularly corn, show a strong analog correlation with how the price action has begun this marketing year. And to that point, if you follow that analog further, right about now in May, we find a bottom for, a little bit of a weather market. Does not take the market back to highs in 2013, but get a solid, rally. Some shorts cover, markets don't head in a straight line down either. So they find resistance, rolled back over, and the rest was history. But soybeans in the near term still in a clear downtrend. Since last week's Strategy of the Week update, we've really just been completely sideways. In fact, we were only about 10 cents higher last week at this time. And we were concerned at that point, similar level, it was drawn from 1390 down to the 1340 area. It was this extension to this lows to lows extension. We were looking at 1350, 1360 might be that resistance, right? Well, it's not so different that 2 days later we found a new low, and at the end of this week, all it did was adjust that fib or that price pull for where that technical ended up adjusting to. But really it's the same story. The market sold off. It's finding support. Does support hold? Well, until it fails, it's $13 seems like a really important level right now for July beans. But it's a double bottom too, which I don't personally love double bottoms or tops. Okay, we can go back to, in April we had a very similar, structure that formed a top in the soybeans at $15. I mean, flip that chart upside down. The period between April 1st through April 20th, when they made the two highs, together, a few more days in between there, but it was basically sideways price action, finding a high. Well, soybeans are making a similar type of structure right here, finding a low. Does that mean it's going to be the low? No, just, hey, $13 seems like a significant support until it's not. Just like $13.40 to $13.50 is significant resistance until it's not. Market has proven itself there in the near term, and while below and above that 50-cent range has really taken advantage of anyone trying to position long or short, unless you caught right the high end or the low end of that range. Everybody's been right and wrong, so to speak, over the last 2 weeks is my point. All right, let's step out to that daily chart now for July beans. And for new crop, both corn and beans, it's almost the same discussion you're having as the old crop chart. Just we've gotten a little more beat up, right? We're talking about selling pressure that took the market to a relatively lower level. But that makes sense when you consider supply and demand. There is no new supply of old crop, coming to market. Hence the premium, right, that we see between the calendar years. And we continue to see that. And that spreading, the bull spreading that we've seen between July D's corn and July Nove beans. There we go. Wanted to bring up beans because we're technically on that as a subject. The bull spreading that we're seeing continue, right, is again, one of those fundamental driving factors that, you don't expect to see in a bear market, right? That doesn't mean we can't, because there's definitely factors in a weather market that could drive, new crop, where old crop could be kind of left forgotten. But, 12.5 cents in July Nove beans, 8 cents in July D's corn. There are also, right, signals or canaries in the coal mine that, hey, maybe the spreads have found a near-term bottom. We've been in a 140, take that back, 130, I guess since March, supportive price band in the July D's or July Nove beans. 160 within the spike up to 180. 160's $1.60 over has been about the high end, and we closed the day at $1.52. We're coming back up above that 18-day moving average. We've found the low end of the range. We're coming back up to the high end of the range, right? So if this is an oscillator for, strength in the market, it was really interesting to see generally just a bull spreading day in the spread that was rather mixed for the beans. If anything, it was a negative day, even though we closed positive. Beans did more damage to the chart to the downside, right? It was a lower low, lower high day over day. Even though we were inside, 5 days back price action, and this is all just a range to me, it'll be interesting to see as July Nove beans approach $1.60 over, if they get rejected again, right? And if beans can't make anything and get rejected at $13.40 in July, well, that might be a good sign that we got a short-term top and we could be coming back down. Now, we go through $1.60 over. The July Nove spread is no stranger to trading $2-3 over. So we could double how the width of this spread if it so wants to, and that would probably be the type of market force that would make July bean short squeeze towards $15. And by the way, would leave November beans somewhat in the dust, wouldn't it? If that bull spread spreads out now. That might mean that July beans rally to $15 or $16. That's a $2 to $3 rally from here. If we were to do something crazy in that spread, if new crop which is trading at $1.70. Excuse me, 11.72. Would probably, I mean, okay, getting back to $14 is a long way, right? And I'm not saying we go there. I'm just hypothetically speaking, we catch a real weather market. There's a reason to think these markets could go bonkers. There's room for them to do so in certain situations, but I have to, right? We have to acknowledge the fact that resistance is resistance until it's not. All right, so July beans on the daily chart. The 18-day moving average is at 1376, 55-day at 1430, 200-day up at 1450, and 100-day up at 1464. You take a step back. This looks like a market that otherwise is just trying to now find support above 13. Resistance is 15. It's a $2 range. If beans can't break down soon, I think the path of least resistance is back to a test of 1380. Prove they want to be down here. Go find resistance. Price discovery could take soybeans higher in a period to simply find resistance that we then fall back down to $13 from. And if that's the case, right, I think we would see a period of news of supporting good weather conditions, maybe bad exports, maybe a rallying dollar, all the reasons that you might want to price ration out demand in that type of event, or find basically resistance. But in the near term, the last couple of days of price action have been very supportive. I don't love that we haven't made progress off that floor, but there's a floor at 13, from a psychological standpoint, from a technical standpoint here, with, a bit of a major double bottom, considering the, lows from last summer were here, and now the lows of potentially almost not quite the same time of year. I mean, we peaked out in June of that year. But this is a massive, kind of multi-year three-wave move sideways. This is that new normal in price that I'm kind of, just continually discussing, right? Of how do you find a floor? Like, do beans, if they want to stay up here, they need to prove that there's a floor somewhere. Well, the only way they do that is you go down and you test it, unfortunately. And I think that's what you're really seeing. And again, below 13, huge line in the sand. I mean, psychologically, beans in the teens, right? Lows from last summer. The continuation chart, you'd see, some other resistance, but just on the July chart alone, even the July contract, is as liquid as it was, kind of peaked out at $13, back in April and July of 2021, where, that was the old peak before a little consolidation, before our massive inflationary run-up. We had the post-COVID inflationary run in food items, and then the inflationary run in food items. Once everything was inflating, foodstuffs, including beans and corn, decided to put another leg higher. But I do think, that coupled with the prices that we saw into the start of this year and into last year, I think that coupled with the rising U.S. dollar, I mean, there was price rationing of demand from a standpoint, from many standpoints. I think prices need to go down and find where that demand comes back into play, and I think we've done that. And now we need to technically prove a reason for the shorts to start to cover, for the market to actually reverse. And once it does, if all of those things are aligning, well, you got a good reason for a big bottoming process or a bottom to have formed. We're not there yet, but we're tracking and watching and hoping that those things continue to play out. All right, let's go up, hop over to corn, because again, on that 4-hour chart of the soybeans here, we're in a clear, still kind of a bearish, a little bit of a bearish, bear flag. I think above 1340 and certainly toward 1350 at this point reverses that sentiment, then calls up the 1380 to $14 test. There's downward sloping trend lines at 50 back for the whole month. That all these things, the old lows that we talked about, that price band as new resistance, a test of that area, and then certainly above $13 and $13.80 to $14. Then now we're back into the old range, and then you can start talking about how everything down here was capitulation and blah blah blah. That's a long way off, right? Short term, the 1340, 1350 area, proven resistance already. It's our bear pennant, the break of which leads you to a test of that next resistance, which was our old range going back, into and through last year. That was our range through this year until we broke below. And of course, back above that area, now we're talking about a reversal, and you can talk about contract highs. But until then, until really you see a $14 print in July beans, you shouldn't be talking about $16 beans. It just doesn't make sense on the chart yet. Fundamentally, you can go either way. And that's where, maybe the next discussion before we get into corn real quick is weather, okay? There's a couple things I'm noticing, and not being a meteorologist or climatologist puts me at a disadvantage here, but by June 1st, we're usually, June 1st technically starts hurricane season. And at the start of hurricane season, we start to see tropical depressions form out over the Atlantic. You can see to the west coast of Africa, you can see some of that warm moisture in the atmosphere forming out here over the coast of Africa in the bottom right-hand side of the screen. And that's actually off the coast of South America too. We typically expect to see these weather patterns be heading from the east to the west towards the Caribbean. And then they come in like bowling balls into Galveston, into Louisiana, into Florida as hurricanes. Those storm fronts will then put weather systems up into and through the Midwest and bring weather into the United States. Whatever's going on with the jet streams or weather patterns, those haven't started yet. You could see a very what do you call it? Prevailing, west to east movement of weather systems still here, right? Anything that's coming up in the Gulf is being swept out over Florida and towards the Atlantic. That moisture is not being pushed up into the Midwest. So for the last couple weeks, these outlooks, which really haven't changed, the 6 to 10 day and 8 to 14 day outlooks, at least I should probably go back and look at all these together, but from what I can tell, we really haven't changed these outlooks over the last almost month. They've all looked this green and good. But that rain hasn't necessarily come. And that's where I think there may be some merit to some of the drought discussions or the dryness discussions that we've had. Drought map hasn't changed much either. The last 4 weeks, you've seen this pretty big weather. It's definitely, shrunk. In certain areas have improved a little bit in the Southwest, okay? Iowa and Illinois haven't gotten worse, but haven't improved. If anything, Illinois is a little more yellow today than it was. Iowa's a little more yellow, not drought. Abnormally dry is, one rainstorm, I'm sure, way from fixing that. But unless these 6 to 10 day and 8 to 14 day forecasts, which aren't really bringing above normal, precipitation conditions to those areas, to the I-states at least, those I-states are actually kind of drying out here. So very paying attention now to those. The point here is to pay attention to make sure that this drought map doesn't, of course, spread into those areas, which I think we all are well aware is the situation to be at hand. But there's also, I think, a general lack of conviction and direction on some of the charts too. When you consider, okay, maybe we built in too much, premium early. Now, or have we, taken all that out? The last few days, certainly where I think we're starting to get to a boiling point with weather, right? If rains don't come, if things don't continue on the course that they were supposed to have been continuing on, the narrative has to change. And so we'll continue to be monitoring that, right? But week over week, this drought map didn't get worse per se. It definitely improved in some places that you would have that were in dire conditions. And whatever this drought impact types, this delineating dominant impact area that they denote has shrunk up now to just around that hard reddened zone. I don't know what that means per se, but obviously trying to indicate to you some kind of shrinking here. But interestingly enough, over the same period, your color, your actual chromatic intensity didn't change. So that's something that I wish I had more color on into literally into what was going on here. But as all things, time will tell with weather and with the drought map. But I don't see some of the shifts that we typically see happening just yet in those bigger jet stream patterns. At least worth paying attention to, and that can all change overnight. I guess one shift in the winds, and all of a sudden, right, you've got hurricane season upon us, so to speak. So, which for the Midwest generally means rain. And in an El Nino year, I believe that's what's typically expected, but we shall see. All right, December or July corn, actually. Corn kind of creeping in here while soybeans lull you to sleep. Higher highs, higher lows. Yesterday we pushed above that 18-day moving average. Today we closed and held our low of the day above the 18-day moving average. So if at the very least you got to call this a short covering rally and a movement off of some kind of pivot low for now. Trading back up though to test into old resistance or old support, now resistance. The summertime lows from last year was a price band between 573 to 588. So we're back above that low. It's kind of back into the old range we were in. But the more recent low from last March, where we've already tested old support as resistance, that was the breakdown in April, short 3-day rally to begin May that held $6 as resistance. That $6 figure is still the real important line in the sand for July's technical chart, for just the short term what I would refer to as inflection zone, or where the book would flip, so to speak, and the market might find its way back into its old range. Is also where the 100 or 55-day moving average, is at 606. 100-day above that at 628, and 200-day moving average up at 650. These 200-day moving averages on whether it's the old crop or new crop July and bean charts, that to me is if I was to pick a level to think about structuring sales into, that's one, certainly one target and wish target for us to get back to, where, hey, we get, it's only 60 cents higher for July corn. We get up to there, don't lose the opportunity the market's presenting itself, that if you didn't take advantage of it the last time we were up at those levels, please, do take advantage of those prices, the next go around, right? But getting back to the 155-day and 200-day moving average, those can be good levels on the way back up to consider structuring some of those sales. If you don't want to make the decision yourself and just let let a mathematical approach to selling into rallies, those daily moving averages on a rally like this, or in a market like this, in this type of environment where we know we got 92 million acres of corn potentially out there at trendline yield, we're talking about just a monster crop. I think we all can agree that that's a very hard yield to obtain, but and certainly given the situations of this year, there's some arguments to be had, right? But the point, that has been continually made here, that Ted pointed out to our team, the addition of that demand year over year gives them some pencil pushing, ability to move their analysis around and keep the balance sheet relatively stable from the number they're telling us now. Okay, you take it away from production, well, you also reduce demand. Did you change anything to the end picture? No. So price discovery being what it needs to be, our prices therefore over. Were we overdone? Are we trading at premiums we shouldn't be? I mean, I think that's why we saw the sell-off we did. And now, that bad news is baked into the cake, so to speak. Okay, maybe the market's starting to think into building a little bit of that weather premium back. Well, we already find ourselves darn near 50 cents, 51 cents, 54 cents, off the lows today in July beet corn. That's a significant rally that we shouldn't, ignore to begin with. So a little bit higher still into that $6 resistance. another time, back above. I think you can't ignore that, but this is a market that's ultimately, right, traded now back up into old support, now potentially resistance. I like that we're back above the 18-day moving average. Those are all good constructive things, but the larger time frame chart is tough to forget there. Now, you take an even bigger step back from the COVID lows all the way up to the 750 highs here for July corn. Looks like two big steps forward and then one step back, and that one step back looks like Elliott wave, 3-wave correction, yada yada, and it's 3 waves until it's not, right? You go below the 550 lows we made, and that 3 waves is no longer 3 waves. So things are in prices and patterns are as good on a chart until they're not. In the short term, though, we know that resistance at 6 is still holding and is there above us, so keep an eye out on that in the near term. But it's going to be a little bit of a fight here for the bulls until there's a true, reason in weather market. Until those drought maps are flaring red, there's just a lot of worry, right, and a lot of concern that with one storm could be gone, right? Maybe not everywhere, but in a lot of places where it matters is the point. That we're just one thunderstorm away from everything being okay again. Now that storm doesn't come, and we find ourselves a week from now with the same weather we've been having, which is getting warmer, right, and dry. We might be having another discussion, but I think that's a good reason. That's, in my opinion, the weather we've been seeing and what have you and where we are is a reason why we're not lower, right? It is a reason why we're kind of stabilizing in soybeans. It's a reason, I think, why corn has actually found a short-term bottom and might actually be setting up into a 40 or 50 cent range for a bit. And that's a discussion we'll continue going forward, but support has proven itself. Resistance is above us. It's got to break one or the other before a trend can set in. Chicago wheat, $6, just like the level that will not break. We've gone below it, but it can't close below it, it seems like. And I think a close below would certainly warrant a little momentum lower. A little shocked we just didn't do it today. We haven't even been above the 10-day moving average in about a week and a half. 18-day moving average at 630, the 55-day at 668, 100-day up at 707. It feels like a lifetime away at the 200-day at 775. Pretty distinguished, still intact downtrend for wheat. Momentum has waned. Oversold conditions have walked off, and it's kind of back to neutral. So if there wants to be another leg lower, for all intents and purposes, from a momentum standpoint, it could do it. But I do think this last couple days of price action and just the lack of volatility, so to speak, move back above 630, why not right back to 660? And then, at that point, I think you got to consider this downward sloping trend line that's basically been holding since November of last year. At that point, you're above 660, you're above that trend line. I would hope that would spark the move back to the 100-day and 200-day, moving average. I think a lot of traders are sitting here and like you look at the, wheat market, you look at soybeans right now. If you're not at least considering to some extent, what is it going to take shorts to start to cover? There's definitely an angle or a side of futures trading that's being missed. No doubt there's a reason both prices have come down, and there's a reason why shorts have leaned into things and done what they've done, right? And had a downtrend. There has been really no reason, fundamentally or otherwise, for Chicago wheat futures to get covered. I can understand why, and there have been bids in the spring in the KC contracts, right? There's a weather market going on there. But they're also at a $2.20 plus premium to Chicago contract, right? So they've already spoken and said that, hey, we're not going to warrant and reflect all of this this bearishness either. But okay, so where, when and where does that happen? Well, that downward sloping trend line, that 55-day moving average is around there. There's a lot of technical reasons at this point to think that we are closing in on some kind of bottom, but I'm not a bottom picker. The lines in the sand have always been clear on the way down of where to kind of the script flips, and we haven't punctured them. And right now that script flips back above the 650, 660 area, and that 55-day moving average around 668. So got a long ways to go, but gets back there. I think $1 higher is possible. And of course, I'm trying to build into the conversation that, hey, by this time next week, maybe we'll be talking about things like that developing, and then structure a trade plan going forward. Because if there isn't a trade that you see today, right, it's about making that plan for how and when things develop. So, all right, KC wheat. Much different looking chart. We've been otherwise kind of pulling back against the trend recently. I thought here we were going to have a nice 50% pullback, 827. We're basically holding and testing the 618 line at $8. Okay, I don't love that. It's a little deeper than I guess I would have liked to have seen it go, but generally speaking, I think back above $8, KC wheat is trying and fighting its way through this 60-70 cent range between $8 and $8.80. It's not perfectly clean there. We've had some dips below, but I think while above $8, my line in the sand in the near term for continued pressure on 9, and then back above $9. And that 200-day moving average at 868 would change the script again. But this pullback that we've seen back into the middle of the range that we've otherwise been in. Not a great look, and otherwise kind of this expanding wedge-like structure. You imagine, and you have to think that you need to see us hold above the 735 low on the daily and weekly chart now for the wheat, for there to be any progress going higher. In fact, you kind of need to stay above 8 for there to be continual progress higher. But having unwound the oversold condition or overbought condition, pull back, 2 steps forward, 1 step back. Hopefully this market is trying to find a bottom now. And if we return back to 9, up and away. And that narrative, I think, would be strongly reinforced, right, by continued drought conditions and weather markets developing in the KC belt. Any kind of Black Sea corridor issues are going to help wheat markets, and escalations and any kind of, I think, conflict would do so as well. And then lastly, a falling U.S. dollar. The Dixie, let's take a look at that chart real quick. There's not much on the short-term wheat charts because of these bigger ranges and the volatility we're seeing. But the dollar index now, right, squeezing back up to that 200-day moving average at 105. We're almost there in this kind of flat or the sideways corrective structure between 100 and 105. Below 100, we've looked at the daily chart and the continuation chart before. Doesn't hurt, I guess, to do it again. You could see how it was the range high over the last decade, from 2015 to 2020. We broke above, we're back down to test old resistance, now a support at 100. Kind of in the downtrend that we began from the 114 highs. I think we're in a little bit of a correction against that. If we stay below this 200-day moving average, below the 105, 106 area, the 50%, we roll back over, we go below 100, and I think we're in a distinct downtrend lower, breaking back into our old range, which I think would take us down towards the 90 area. And again, that old range of 100 to 90 that was holding from 2015 through 2020 was precursed by a 70 to 90 range or whatever it was from the 2000 to basically 2015 period. It was more like 2010 to 2015. So it's been these 10-point ranges, 10 to 15-point ranges in the Dixie. We're coming back down. And if that dollar strength continues to wane, if we fall back into our old trading ranges, I think that would definitely help, the idea of a commodity bid in general, but certainly, more importantly, it helps the idea of supporting our export markets, because that purchasing power from our export partners goes up, and you'd expect to see some upticks in exports. And maybe, the recovery of the dollar from 100 to 105, maybe that's a reason we're seeing cancellations. Maybe maybe our export partners are hoping to find lower prices for commodities in the future, and certainly are trying to would much rather cost average down, right? Because that's their sole purpose as the buyer of of what we produce, of the commodities we produce. So. So the dollar strengthening in the near term, resistance above us at 105. I think we're getting real close to where the dollar, might be rolling back over. And if that's going to be the case, I think could be, helpful to the rest of the commodity spectrum. Gold markets, pulling back here, 1940. That's a 50% from the 1806 swing to the 2085 high. Let's get the exact level here for you. 1947 is that 50% swing. It's also a pullback into the highs from February, and a test of the downward sloping trend line, from the April of 2022 high through that February of 2023 high. That old trend line broke into resistance, now support. If you draw a channel on gold, channel support right around here, around 1940. So, okay, is this gold finding, the supportive area between 1940 and 1900 where you could see, continuation higher? I would imagine we really want to see that chart of the dollar roll over at the same time. I'm not so concerned in needing to see the S&P get bearish for gold to rally. No. I'm not a believer in that correlation on a long term. I think in short-term charts, there's certainly some days where there's traders that get spooked, and asset prices might do that, but and that negative correlation might exist. But over the long term, there really isn't much correlation between the stock market and the price of gold. When the stock market's bearish, gold's not necessarily going up. In fact, in 2008, you saw everything falling together. And then the period that came after that, when the Fed policy shifted, gold got bullish. Right. Once that's when that's where I think the correlation really is that with gold, it's more towards whatever, an anti-Fed policy type of dynamic, right? It's a hedge against the dollar's inflation and money printing, right? That's the idea. But then you turn around and that type of process is supposed to be good for the stock market, right? And whatever. So I think that dichotomy is what's playing out. So there's not necessarily a correlation. Correlation doesn't mean causation here, right? The two might be affected by certain policies and things, but it's not mutually exclusive. All right. Anyway, below 1900, 1850 might be interesting, but the truth is at that point you've really just traded back into the old range that we've been in for gold, and you might be wise to consider a swing down to 1600 could still be possible. And I only say that because that is just the range for gold from 2020 through today, about a $400 range. However, I think we're down into the technical area on the chart that if the market wants to find a bit of a bottom, and I'm not saying you go straight up to, through highs from here, but going back towards, and above 2000, in a period of price discovery back up, wouldn't be out of the question. And so, okay, that correlation between the dollar topping and gold bottoming here on the short-term reversals we've seen in both charts since April might be interesting thing to follow, right? Okay. Crude oil down today, and I think a lot of people, including ourselves and even Reuters, struggling. Read an article earlier that was citing, inconsistencies between Russia and OPEC deal on why we were down today. I think that's really grasping for straws, for trying to find reasons, why oil's down. And I don't blame anybody. I was searching for them and making guesses too. I think that's a wise assessment to think that, and to say that, there's inconsistencies here with what OPEC's saying and Russia wants and the cuts. I also think that there's a big, the United States government's in here, trying to stockpile, right, that strategic oil reserve. So there's a lot of moving parts and a lot of big macro players involved in that conversation, so to speak. So it's very hard to pinpoint any one reason why there's a $3 move in oil. But if you go back the last week and a half of oil trading, that's all oil's really done is 70 to 74. So it doing it in one day, okay, it's just the range we've been in, trading very quickly. Could it be something more? Certainly. But for all intents and purposes, oil's been a pretty volatile asset over the last several months as these big macro players are in a fisticuffs battle over production, supplies, and demand. And it's got geopolitics written all over it. So from a technical standpoint, just talking about price action for the last 2 months, highs of April to the lows of May, 50% shorts at 73.59. That 73 to 74 area is still holding as resistance. From the lows of May through the highs after, the 50% supportive area is around 69. Maybe a little higher now with that new high. But the point is that right about 70, we found support. So even the technical traders can't make up their damn minds. And crude, 50% on both sides have been holding. The price action since December seems very comfortable between $70 to $78. And I think that will probably continue for the foreseeable future. We were just considering, kind of some demand questions and playing through some ideas in conversation in the office today. And we're kind of, a little amazed as to looking at gasoline, ethanol demand, looking at just demand in the energy sector in general, how well it's holding up in all of these price battles. And generally speaking, I think at the $3 a gallon price point across the country going into the summer, I think people are going to be driving around a lot. I don't think that we're setting ourselves up for a lot of price rationing of demand from consumers or in energy markets right now. So certainly, a recession could cause that demand to drop and what have you, but I think consumers, and I think we're going to see a pretty active summer. The only thing that's getting hit right now is pork prices. I mean, gasoline prices have kind of stabilized. Cattle prices and beef prices are really high. But maybe this is a summer for ribs because they seem to be absolutely on discount. So I guess that's a leeway into our cattle and hog markets, but crude oil kind of very range bound. Literally not a conversational change since last week's chart. And I don't see anything to change in that conversation until we're above 76 or below 66 at this time. Lean hogs, let's take a look at them real quick. And we'll touch cattle. And I'll finish with the S&P, kind of a weird roundabout way of getting to risk appetite, but there it is. June hogs absolutely obliterated over the last month, but just since January cannot find the log. August hogs chart is equally as hit here. 18-day moving average still way above city 45. I mean, you got to go back to daily continuation charts to kind of see and paint the picture of where and maybe how much further down we can potentially go. Taking the $40, $50 COVID lows out of the picture. The average price for hogs over the last several years would probably come in around this 80 figure. Okay, maybe a little higher, maybe about 84. Trend line, right? Kind of average comes in around 93 or 4 right now. So maybe prices had got a little overdone. Now we're back to, I think, where there's value is what I'm saying on the longer term chart. And it's very hard to say that when you're a falling knife. So I'm not advocating stepping in and buying here. We're oversold conditions on the RSI. We're below every single indicator. You're closing at lows with lower lows and lower highs. nothing on the chart that says buy this chart, with the exception of just hubris and hope, neither of which are good reasons for trading. There is a bit of an open gap, I believe, from today's open, which makes, I think, move back above 80 very interesting and would get me very excited to get long. But outside of maybe talking about the potential for setups and what they would look like and how, what you need to see for them to happen, I do think we're getting towards the low end where we've gotten overdone. I think this market has gotten pushed to an extreme. We have wiped out any real sense of speculative long, right, that would have been in the market. Anyone that isn't a commercial interest is probably gone at this point with this type of move. Maybe a little more pain on the charts, but generally speaking, right, I think the capitulation has been had down into value areas. Once we see a reversal, a technical reason to be along, I think there's a lot of opportunity there, especially with knowing where cattle prices are. Cattle prices literally in June making a contract high the day that June pork our lean hogs are making a low. Something is off here. I think that spread is hitting a wide, literally it's 100, almost 100 wide. It's 90 wide right now. I think that's gotten a little too wide and will snap back. And I think a good way of doing that rather than just selling cattle would be to buy hogs here, right? We're going to have to wait for a reversal here, but I think there's going to be some opportunity. Probably won't do it in the June contract. We'll be looking at August, but that'll be a conversation to be had into next week. All right, and last but not least today, let's look at the S&P 500. A quick look here. We're still, really just putting up this fight against this 4,200 resistance. There's a lot of trend line, resistances on the charts that we're kind of chewing through that you can find as now support. Generally speaking, I think, the market, I see no reason why we can't break back down, right? But the narrative of a bull flag chewing away at resistance is still at play, and still kind of bullish above, bearish below that 4,100 area in the near term. Really 40.62 lows of the month, I think, are pretty important now. Below there, below 4,000, I think it opens the door 3,800 and 3,500 relatively quickly. But above 4,200, 4,300, 4,400 should be no, piece of cake here once and if the market really wants to get going. And then I do foresee, another pullback and some up and down price action. But generally speaking, I believe we're formulating and have probably seen a bottom already since last November. And if we're in some kind of recession right now, 2 quarters ago was that bottoming in the stock market, okay? So if we think we're going into a recession, if we're making lows at the stock market, set your clock, 4 to 6 months from now, and that's when the recession will be in the newspapers. So, but I think that's what we already had, and now the recession's in the newspapers. I don't think it's really a recession at all, but whatever. Market doesn't listen to me. If it did, we'd all be far richer. I promise you that. But jokes aside, I don't love that the stock market hasn't made its move yet. But and that might be cause for concern and reason, to think. But hey, it's there until it's not. And I guess last but not least, I did want to touch on one last market. Cotton has gotten absolutely beat up the last few days. December cotton going below its kind of consolidative wedge or triangle-like structure. It's still very much in its much larger range, so I'm not that concerned about the chart. December, you really want to see it stay above 77.50. I didn't want to see it go below 80, but maybe this is capitulation and maybe response to some of the improving conditions and the favorable weather forecast for, that cotton belt down in the Southwest. That's otherwise been very, places, you look at that drought map and, the wheat, the cotton, and all those acres aren't exactly, some of those acres are problem acres. Anyway, and then others aren't though, right? And some of the crop looks very good, which is probably the reason why we failed to break out. But generally in July cotton here too, upward sloping trend line, we're back down to test that here at 80. I think this is the low end of the range. I'm expecting us probably to go back up, but we need to see support prove itself here. So, moral of the story, to run through everything here for a quick recap. July corn, we're back up, testing $6 resistance. Keep an eye out for that. I think if it could break above it, could get a story happening here. The July beans, very much a range, 1340 to 1300 here. Today was good price action above today's high. Look for short covering back towards that 18-day moving average above 1380, and a test back above that area sends us back to the old range, and we can start talking about much higher prices. Chicago wheat above $6. Fascinating lows forming. I think we're losing momentum to the downside, but generally speaking, I don't know until we're back above 650. I don't have much comment here. I like KC wheat a lot better. If I was a buyer, this is where it'd be. I thought we got a nice reaction. We're starting to from that 50% area. Today we've started to try to knock out the weak-handed longs, but I think back above 850 here, this chart flips bullish again for a move back above $9. We'll see what happens. Have a great day, everybody. Thanks for joining me. My name is Dan Hussey with Zaner Ag Hedge. You can always reach me over here at Zaner at 312-277-0110. Find me on Twitter at Daniel Hussey Jr. Dan Hussey, SOTD on Facebook. Or shoot me an email at dhussey@zaner.com. Thanks a lot, everybody. Have a great weekend. Have a great day. And we'll be back with you as price action develops. Take care, everyone.